Let's talk to Malcolm Graham Woods. He is an independent oil analyst at Malcy's blog. Malcy, very good morning to you, young man.
Good morning, nice to see you, miss.
We've also got Tim Gregory, who is an investment manager for Vermeer Investment Management. Very good morning to you, young Tim.
Morning, Nick.
Right, a three-man committee. I thought we'd talk about public transport but, as we all come into Victoria, but that's a tale for another day. A few notes to sort of get you going, if that's the right word. World markets, first half 2018. Brent oil is up 19%. NASDAQ is up 9%. And to put that into some sort of perspective, the FTSE is up 1%. Bitcoin down 58% for the first 6 months of this year. So the price of gasoline has risen by a third over 12 months to $3 per gallon. The old adage, $20 used to fill up your car and buy your breakfast in the States. The headlines now, you can only basically fill up your car. Okay. Brent crude up 58% over the past year to 78 per barrel. Petrol up 13% in the last 12 months. This is eating into people's household budgets, and this obviously could be a problem. And they're talking about $100 potential that would lead the world into a recession. Mr. Trump on his tweet recently put, looks like OPEC at it again. Oil prices are artificially high. No good and will not be accepted. A recession would do this at $100. Sent out a further tweet yesterday. The boys will cover that. Okay. Oil. Has it ever been so exciting? As a fund manager, as an oil analyst, okay, you've got geopolitical, you've got political, you've got Twitter, you've got the American motorists, you've got recession, you've got Goldman Sachs saying it's going higher again, and we know what happened last time. What are your thoughts, Malcy, to kick us off with?
Well, I mean, there's no. I mean, it's never been so exciting because oil is a typical commodity, and over the last nearly 40 years covering it, I've had equally good times and some equally horrible times. Just to cover the Trump bit, where he says it's unacceptable and everything else. So, firstly, we know that Trump can't decide OPEC oil policy, and the Saudis will do what they want. But you mustn't forget that they have a shared interest with the Saudis that they both hate Iran. And it's in both their interests for Iran to come under severe financial pressure, which will happen after November. And as for the gasoline price, I mean, actually $3 a gallon in the States is only 40p a litre. So they're still getting quite cheap gasoline in the States because they don't tax it as much as we do. And over the years, it was only 2 or 3 years ago that the gasoline. The garages in the US, you couldn't fill your car up with because they only have a limit. In those days, they had a limit of $25,
right,
or $50 in some cases. Now it costs $100 to fill up a car.
Okay, Tim, you manage money. Okay, are you long oil at the moment?
We're neutral to modestly overweight in oil, and as you know, is the view we've been taking about how to invest in oil has been what the pain, and to the point that was being made earlier about how much the oil price is up. You've got to remember that this time last year we were very close to the real misery levels, of the low. So the rally has taken place from a very low level, and we're back in the 70s, which is still a long way from the peaks of pre-14. So our view has been that the cautious way to play oil has been that there are a number of very high quality companies who've spent the last few years reining back their capex, finishing some significant projects, and now they're harvesting the cash flows at a significantly lower break even. So most oil companies, or a lot of oil companies that we look at, sort of plan their break evens now around $50, and so at 70 they've become really profitable, really cash generative, really able to pay dividends. So the companies that we invest in, like that, Chevron, Equinor, which used to be Statoil, have really lowered their break-evens, really improved their cash flows, and are paying good dividends to investors. So that's kind of the safer approach to it. We've also been adding 1 or 2 positions. We bought Schlumberger in Oil Services because we think that actually, if oil capex doesn't start to pick up, the risk of this potential $100 oil or something like that is going to increase. So there's going to have to be a recovery in the capex cycle, albeit that it's taking longer than I think people thought, and the lead times on this is quite long. And also we've been investing in a thing called Woodside Petroleum in Australia, which is a real LNG natural gas play, which is another industry which has suffered from a massive downturn in capex and the Chinese and Japanese and other Asian countries want clean energy, and so they're buying, and we think they're going to buy a lot of gas going forward to reduce their coal consumption. So we're finding different ways to play oil,
Right.
which isn't reliant on oil going from 70 to 100. If oil stays at 70, and Malcolm knows much better than I do whether the oil price is going to stay at 70, go to 100, come back to 50, we're not trying to make that judgment. We're saying oil stays around anywhere around here. The companies we invest in are going to do a lot better. But if it comes back to 50, we still have a substantial safety net in the companies that we look at.
Understood. So, Malky, the million-dollar question, where does oil go from here, in your humble opinion?
Well, I think we're in quite a good spot, actually, because I think between 70 and 80 encapsulates the areas. It is clear that the Saudis and the Russians were a little concerned when it got to 80 and just went slightly ahead of it. So, and they're worried that they do generally take away quite a bit of demand if it goes over 80, and certainly if it goes to 100. And the other thing is that we've known that the Russians have wanted to increase production for a while, and we know that the Saudis want to do the same. So actually, I think, by my numbers, that already between them this month, they'll probably almost put on 1 million barrels a day between them. The Russians can only do a bit, but they'll get above the magic 11 million barrels a day. The Saudis, if it hadn't been for the summer, they could probably put on 1 million barrels a day straight away.
Yep.
They use a lot in domestic power in the summer, but no, I think they've put on 500,000 barrels a day in the last 3 weeks. Trump doesn't come into it as such, but I think it's in everybody's interest to make sure that it doesn't. There's no way it can really fall dramatically at the moment, barring anything, on the oversupply side. Demand in the second half of the year, and Tim will know better than me, but GDP demand and everything else, and therefore demand for crude itself is quite strong in the second half of the year. I don't know about after that, but so I think we've got a reasonably good. And don't forget, as Tim alluded to, we've got at $70 to $80 in the last 3 years. I mean, don't forget we troughed at $27 in February 2016. Since then, over a 2-year period, almost every company that I look at has cut costs by 50%.
Yep. And
some of them over the extended 3-year period since 2015 by 70%. And we had a fear in the other day, and he said he's cut costs by 70%. But that means that America, who announced production figures today, they're selling their crude for 75, and their costs have just gone below 20. And Rockhopper, who announced the lead bank for the Sea Lion development, that was something which was a bit dodgy, sort of 40, 45. It goes ahead easily like that, and at 75, you're in very good form. So I'd expect the FID for that.
Okay, Tim, Tesla, batteries and the likes. Okay, he's obviously hitting headlines. What does this mean to the price of oil over the period?
Well, over what period? Because the whole issue here is, to what extent is the electronic vehicle going to be able to penetrate overall market demand?
Yep.
How is that going to change the landscape, and when is it going to happen? So, I don't know, to be honest, any better than you, Nick, whether the electronic vehicles will have penetrated more by 2025 than some people think, or by 2030 it will still be very minor. There's an enormous amount of water to go under the bridge before we know any of those things. So I think that's absolutely impossible to forecast. I've got no doubt that there will be tremendous penetration of electronic vehicles in the very long term, but that can be a very long way away, and that won't change the landscape for the oil price on any sort of short-term investable basis. So I really don't know about 2025 and beyond, but to 2022, I don't see how it can change the landscape.
You can't shift the needle for oil, and don't forget that all the oil that goes, or even, and especially we talk about gas here, going to for generation purposes, because you still can't park your car and fill it up like you can with petrol and the electric vehicles, and there are swathes of large continents where you're never going to get and the other thing is that I'd love to throw the odd big sort of frightening stat into the process.
We love those.
Yeah. Well, okay, we've done this before, but in March, which was the last official month for the AA of the USA, gave figures. It was another record month. So Americans drove 368 billion miles in March alone. Okay.
Wow.
and the average age of a car in the US is 18 years old.
Right.
Yeah.
Now, you think you're going to turn that over?
Quickly.
Tim talks about
It's not gonna
2022. It's not going to happen. So it isn't going to move. And don't forget, there are so many other things that come out of a barrel of crude oil when it goes into a refinery. It's you know, the actual gasoline is reasonably small. You know, unless the plastics industry comes to a standstill, you know, the refineries will be chugging away for a very, very long time.
Okay, so my final question to both of you. Sorry, Tim.
That's all right.
I was always taught as I grew up that in terms of the price of crude oil, there was about $10 of geopolitical risk in that price. Now, is that reflective of what's going on in the world today? Is that still the case? $10
No,
of
I
the
mean,
makeup.
well,
Is that
I mean,
now
not-
5? Is that now 20? Or is it just...
No, it could be 20, because the point is we get to the stage in November when the the sanctions on Iran really kick in. And it has been obvious that that a number of companies, Total, for example, who operate the South Pass field with them in that area, are going to stop producing. So on one hand, we're going to have obviously a lot of production off the market, but you know the Iranians control the Straits of Hormuz, and if they do get nasty about it, then they can stop more crude coming through and get the price out. So you know, if that happened, I think there would be a $20. But as it is, I think with the normal course of events, 10 is a good guideline over the longer period.
I mean, that seems to make sense to me. I think to Malcy's point earlier about GDP growth, I mean, I think we're going to see a very strong second quarter US GDP print, and clearly the tax cuts that we're seeing in the economy at a time when unemployment levels are already pretty low in the US. And I mean, there may be some kick up in the participation rate, but I mean, all the companies that we speak to suggest the labour market is pretty tight in the US. So it's not just oil price inflation pressures that you might have to worry about going forward. And I think in addition, we're already seeing, perhaps as a result of concerns about trade, a response from the Chinese cutting their RRR, and you know, seeing one or two people suggesting actually that far from in the short run the expectations that Chinese economic growth is slowing, which it clearly has been, because Chinese policy is clearly driven by a higher quality of growth rather than a big number, that there is already evidence that they're trying to re-stimulate their economy to protect themselves potentially from what might be happening in trade. So second half GDP in China, which is a massive consumer of oil, could be actually better than people expect, surprisingly. And you know, that could be good. Yeah. Another additional swing demand boost, you know, for the oil price. So if anything, I think, you know, I would certainly be in the camp that if the oil price is going to go in any direction in the short run, it would be likely to be higher.
Yep.
I agree with that, Malcy?
Yeah, I do, yeah.
Right, gentlemen, we're running out of time. Give me a final thought each.
Well, just, I think, you know, that point, ex-oil, that, you know, the US economy is doing really well. I mean, the stock market's really struggling. We've been stuck at around 2,700, around the S&P 500, it seems, for a while now. But the US economy is doing really well. So the Chinese economy might be being actually re-stimulated for the second half. So all the gloom and doom that's around at the moment, all the fears over trade wars, all the impact that's having on industrial stocks, commodity-related stocks. I mean, I think the one thing that we can say is if the oil price around here for the time being is about right, oil shares are priced implying a lot lower oil price. I would say something in the 50s.
Yeah.
Malcy might know better than me for the companies that he looks at, but the companies I look at look to me to be priced for $50-something oil, and we're over 70. And you know, who knows? But if we're right and the oil price stays around these levels or even ticks up a little bit, that to me implies that oil equities have got some upside from here.
Understood.
Yeah, and equities normally track the oil price quite closely, and they've moved apart a little bit at the moment. But the other point I was going to make, well, the sort of final point for me was the fact that we will see in the next 2 or 3 months where anyone who can produce more will. So the Saudis, as I said, will produce more, up to 1 million barrels a day. If it gets, and the Russians will do maybe 300,000 barrels. If it gets to the point in the autumn and the winter that GDP might be falling off, or 2019 numbers are going to be a little bit lower, the Saudis know perfectly well, as they have done for the last 18 months, since November 2016, when that operation came in, all they have to do is to cut back production a bit. So if you see the oil price drifting, they'll just cut back their production a bit, because they want to help Trump, they want to be an inconvenience to Iran, but they also want to make sure that they get the coffers in. And I think they've pitched sort of $75 as being about the right price.
Gentlemen, always a pleasure. My final question to both of you, is it coming home?
Football is coming home.
Football is definitely coming home.
Thank you.